Welcome back, my passive income investors alike. Today we're taking a look at the true north, the Canadian north, where I live, a REIT that was suggested by one of you beautiful subscribers. And today we're going to break down everything about this REIT and why it's kind of getting added to my buy list. Because damn, I've never seen REITs that look quite like this. I usually don't look at small cap REITs. I usually try and stay away from small cap companies as much as possible. But this company, oh boy, it gets my boop, boop, beep, 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 my little sensors inside my brain going haywires. I'm trying to find holes and flaws in this company. Not only that, but this company is paying a whopping 9% dividend yield, guys. It trades at a forward PE or PE ratio of 7.6, and it's only got a $382 million market cap. So I look so forward to breaking this down for you. So let's jump right into this. Welcome back, everybody. Now we're gonna break this down. This is an awesome company, guys. I think, don't quote me on that, I'm not a financial advisor. I shouldn't be making financial statements, but damn, I love this company. We're gonna look into this because it's a REIT that pays out a really high dividend yield. And in fact, that dividend yield, guys, they offer a drip enrollment plan, which a lot of companies don't, but this company does, where essentially if you put up a drip, which just means that the dividends or the money they're going to pay you for owning this stock, you can take that money and instead convert it into more shares. So they will pay out in shares of the company, and they will give you a 3% discount to do that, a 3% discount. It's kind of beautiful, actually. But what I want to do is look at this REIT's companies, or not companies, this REIT's real estate and the companies that rent from them and lease from them, and figure out if this company is actually worth buying or not. And in my opinion, I'm not going to break it down yet. I will give you my own opinion. It is a smaller cap company, guys, a much smaller cap company, but don't let that discourage you. And it's a newer company, which is another kind of red flag. The two things that are a big red flag to investors, guys, is how small cap, and I know 380 million might sound like a lot to you, but trust me, in the world of companies, it's not. It is not at all. Actually, this is the size of, if you don't know, the great Grant Cardone, Uncle G. His real estate firm is actually worth more than this with the equity they have in it. But this company's only been around and has only been public since 2013. It's a fairly new company. I think they issued to go public in 2012. And as we can see, we've only had an actual negative asset return if you bought right on the IPO. But that might give this an indication that this might be an undervalued company. And I'll explain more about that in a sec. But we're looking at this crazy yield, and all we want to see is this yield sustainable? This PE is really, really low, guys, because if we compare it to other REITs, especially larger REITs in Canada, like REIT.UN, RioCan, stock chart. Let's take a look at RioCan. RioCan is it's the second largest REIT in Canada. And I'm just going to open this up real quick. I wish it came up on the thing. But just to give you a quick idea, guys, way more volume, way bigger company, way smaller yield because it's probably going to be a little more stable. But the market capitalization is $8 billion. But like I said, way more trading volume, which matters. And the PE on this is showing, yeah, it's 13 or 14, pretty much dead on. And this company has a lot longer of a track record. It's been around for, I think, since the 90s or 80s. Don't quote me on that. It's a much older company, though. And we're talking about trading in the billions of dollars here. But we're not here to talk about RioCan today. We're here to talk about this beautiful little company and why I think it's worth buying, which I'll give more about my opinion, like I said, toward the end. But before we get into the balance sheet and all the boring BS, I want to show you the properties. Because before we look into any REIT, the first thing we want to see are the properties we would like to own, including their worst properties that exist. And because I don't know outside of the country that well, or outside of the province, I should say, because I live in Ontario, I want to focus on the majority of their properties. Literally, the majority of their properties are in Ontario, and they're actually all in areas I know extremely well. I've never looked at a REIT where I actually knew most of their properties and I drive by them on a regular basis, and we're going to show you that right now, guys, by maybe just picking a few of these. Richmond Hill is one of the richest areas in Ontario. Hamilton, really nice area. It's more industrious. Pickering is actually just down the road. We're going to look at Carlington Drive. I drive by this I've drove by this piece of real estate every week for the last 7 years almost, literally. Mississauga I know really well. I know all of these areas. Peterborough, My cousins are from Peterborough. London's a little farther. Sarnia's a little bit farther as well. I think it's more north. Don't quote me on that. Mississauga, Burlington. So let's just take a quick peek at a few of these guys. I've looked at some of their worst REITs already. They have some really ugly real estate in Toronto, but the majority of their properties are really, really nice. And after we go over the properties, we're going to look at the tenants. So here's a really nice one. This one, like I said, is one that I have actually driven by on a regular basis. I come down the major highway here, the 404, every bloody week. Oh my God, guys, I come by these properties all the time. So here's one property. And what I like to do is if you really want, you can go down, you can actually select street view, which is what I'll usually do. And you can actually take a look at these properties directly. I probably didn't get that right over where I needed to be. But trust me, you can do a street view of these. It's nice that you can see them that way. So here's one in Hamilton. Hamilton's more of an industrial area, and it looks like it's in more of the industrious area of Hamilton, because all along this lakeshore area is mostly big industry, which you can imagine is this company is renting to basically big industry. But we'll get more to that later. Let's just keep looking through a few more of these properties. So here's the one in Pickering. I actually looked at this one directly. I can see this one. It's literally about 30-40 minutes away from where I live. And I actually used to do a lot of jobs in this area because Rotary Park is where there's some halls where we've done some weddings. And this is just down the road. So maybe we'll do a quick street view just to show you guys exactly what these properties look like, because it's kind of neat that I can just plop that right down there. And we can scoot on around, and here is the building, as if Google drove right in the parking lot and showed us this beautiful piece of real estate right here that's currently being rented. And I can't get over their tenants. So I think what we're going to do is we're going to go into their forward-looking presentation so I can give you guys a full, proper breakdown of this company and if it's worth a buy or not. So this should give you a rough idea of some of their properties. Like, here's an uglier property. This is a horrible place to have real estate. You're right next to the airport, literally right next to one of the most major airport in Ontario, and it's just crammed against all these major highways, guys. And it's a cash money checking. So this is probably one of their worst piece of real estate. Actually, let's take a look at this, because this is what I talk about, guys. When you're looking into real estate, you want to make sure you're looking at the worst pieces, because I can't even get street view to get on there, probably because it's one of these buildings down in here. And oh my God, we're gonna get hit, guys. We're gonna get hit. Run! I'm just kidding. I'm weird sometimes like that. But anyways, well, let's get out of the real estate, guys, because that's one of the more ugly ones, rented to a cash money guy. Whatever. There's always a couple of those in your real estate portfolio, but most of these properties are properties outside of Toronto in growing areas. Anything downtown, I think, is either priced in or overpriced, but anything on the outskirts of the city are beautiful pieces of real estate, and this company owns a lot of those. So let's just take a quick peek into their presentation, their investors presentation, guys. So we got $964 million in total assets, and I'll explain how you get the market cap out of that valuation. But $964 million. We got 46 properties, 3.7 million of square footage, 4.3-year weighted average lease term, so about 5-year lease term, which is healthy, especially if the tenants are going to re-lease, is what you want to see happen. 97% occupancy, which is extremely healthy. Usually want to see around a 90. I like seeing it around 95 at the like the lowest. You usually want well in that 90 range when you're talking about occupancy rating, because that really says a lot to management that they actually can and they know what they're doing when it comes to buying these properties. 79% of revenues generated from the government and credited tenants, which is exactly what I want to see. And the stock was down when they clearly posted this because the yield's a little lower than this today, but still not bad, closer to that 9%. So scrolling through, guys, here's our strategy. They're going to show, obviously, their nicest pieces of real estate. I hate that companies do this all the time. Like I said, always look into the company's worst pieces of real estate and see what they're cash flowing, because that usually says a lot about the company. But either way, these are some of the really nice properties. I like the fact that they own Ottawa, growing places for real estate, Mississauga, growing places for real estate, Pickering, growing place. Like the major properties they own are really, really good locations in my personal opinion, especially considering I grew up in these areas. This is my working home. Toronto is my my backyard. I live a little farther out in the country, but it's my stepping grounds nonetheless. And as we scroll through and take a look at the tenants, guys, absolutely amazing. It's nice that the largest revenue comes from correctional services, and believe me, I know a lot about correctional services, considering I own one of the largest correctional companies in the U.S. dealing with prisoners. That's why I also like this REIT, because their tenant diversification, TD Insurance, insurance company. I mean, what more could you ask for a tenant? And these are the largest paying tenants, the Canadian government and an insurer. federal government. Amazing companies. We've got Alberta Infrastructure, Lumentum, Ontario Power Generation, Alberta Health Services, LMI Technologies, MGMT Board, Secretariat. I'm saying that so wrong. Secretariat. Am I saying that right? I don't know what that is. But that's another Ontario government one. That's a provincial government. We have Staples. Probably my least favorite one in this whole portfolio is Staples, because I just can't see Staples being a long-term tenant. But General Dynamics is another really good company. All of these companies are beautiful, guys. I love seeing this. So we got, what is this? This is the recent acquisitions. So they've done $489 million in growth in assets, or 2 million square feet added, which would probably be these properties here, which we can see is Richmond Hill, a beautiful property in my personal opinion, beautiful location. Markham, beautiful location. I've looked through these properties. I love all of them immensely. As we can see, the majority of their properties are in Ontario, which is my stepping ground, so I know this very, very well. So here's where things get a little bit more nerve-wracking, because what we're looking at is portfolio lease maturity. So when leases come up, you really want to get a release to continue with these tenants, or depending on what they want to do with the properties, who knows? Maybe they think the properties are worth selling or trading for other properties. This all really comes down to management at this point. But what we can see is at least till 2024, so over the next 5 years, we have some real stable leasing, which means this income should be pretty stable over the next 5 years. Industry leading occupancy rate, TNC, which I'm going to presume is, you mean TNT? What is TNC? So I guess this is just the average tenant. They're comparing themselves to the occupancy, and they're one of the highest, because it's kind of impressive that H&R, a lot of these companies, they don't have this, their tenant leasing isn't nearly as nice. What scared me a little bit is you can see that they've had some issues with some of their tenants, and like I said, I don't want to see this drop too much below 95%, because that might mean there's a problem with a certain form of tenants that they look at hiring or leasing their properties to. You don't want to just lend your properties to anybody. You want them to be really good, secure income tenants. But we can see over time, guys, they've done an incredible job at sustaining this, maintained conservative leverage, and this is the number that is the most beautiful in my eyes. Anytime I'm looking at a REIT, this is the first number I look at, and I'm going to explain to you what this number means when we get into the balance sheet. But we have a 3.4% weighted average in interest rate, which is unbelievable, a 3.58-year weighted average mortgage term, which means these are usually, you know, in their debt maturity, depending on what their setups are in their debt, they might be doing finance only, or what's the term, interest only debt, which means they might just be renting these out to try and get the cash flows up to buy more properties. I don't know specifically what their leasing terms are. I'm going to have to look more into that personally, but just as a quick overview, this is the number we're going to keep our eye on, and I'll explain more about that in a second. But as we keep scrolling through, there's not much else to go over, guys. They've done an incredible job on net operating income increasing over time. A really healthy, stable dividend. They've never done any real dividend cuts. The dividend hasn't grown at all, but as we can see, with an average rate of return, and I imagine this is reinvesting the dividends as well, it's done quite healthy. So what do we got here? I want to see what this chart makes up. So let's see. We have True North, Canadian Office REIT, and S&P Cap REIT. So comparing to all the other industries, guys, essentially this stock has a little more volatility, but I think because it's a monthly payer, it's following nicely against all the weighted averages. But we can see when something takes a turn here, this company can drop a lot because it's an individual REIT. They have a little more volatility. Any stock that pays over a 5% yield has a lot of volatility in my personal opinion. It's just the way it works, because there's a lot of cash getting transferred around, and it really affects the underlying equity. But let's move into the balance sheet so I can show you guys why that number matters so much. I'll zoom this in so you guys can hopefully see this as clear as day. And what we're going to do is what we mainly want to look at before we look at anything, and my favorite metric of all, is total assets versus total liabilities. This says a lot about a company, because essentially if you sold off all of the assets today, what would I be left with money in my hand? Well, I would be left with about $360 million, give or take. And that is where that ratio comes from. It's a debt to asset ratio, essentially. And if we take the debt to asset ratio, guys, we can see at, if we just simply, you know, take the total assets of $966 million and minus the total liabilities of $609 million, and we get left with roughly $360 million, which if we go back and take a look at this REIT, if we go back, let's get out of here again and go all the way back to the True North, we can see that the company is trading at $382 million. So it's actually only trading roughly $20 million above its underlying asset value, which is usually what you want to see when you're purchasing a REIT. And I just can't get over that the PE is so low on this, but usually these lower income, or these lower market cap to REITs are a little snubbed upon. People don't really pay as much attention to them, which is why I'm trying to shine a light on this company right now. But overall, the companies have got quite a healthy balance sheet. REITs, by law, have to pay out the majority of their income. So really all you can do is look at their income. And this company has another few things that bother me a little bit, which is usually, I'd have to find it in here again. I'm not sure where it was hiding. But usually when you're looking at what they're paying out and basically like leveraging, because all of the basically the money you're losing is going to go out to management fees, people managing the properties, managing the tenants, and those fees go up, and they've actually gone up quite a bit in here. But because they said they've done about 400 in recent acquisitions, that's probably why it's gone up so much. And that's just general like administrative costs, and that's hidden in here somewhere. But it's when I'm looking at REITs, I always want to see what their general administration costs are, because that would tell me how well the REIT's getting run. Like if it's low compared to the income, which it usually is, but you want to make sure they know what they're doing on the management side of things, and that's a good way to gauge it. I'm just not going to find it in here right now. But overall, guys, this company has actually made a serious part of my watch list. It's on my buy list currently, and when I say buy list, I mean I'm going to analyze it a lot more and just come to understand it in a way that I'm comfortable. But the more I look into this, the more I like it. I love the properties and everything about this. It's trading at a really low PE compared to most of its peers, and it has actual equal to or better than performance than most of them. So and the other thing, like I said, the fact that if you set it up on a drip system, guys, the drip will actually pay you a discount. So you can buy more shares at a 3% discount if you just buy a little bit, set it up on a drip, and let them buy their own shares back. It's a really interesting company. I like it a lot. It's a very, very interesting piece of real estate, guys. So the other thing that I wanted to talk about real quick is the Cardone Capital. I mentioned this in the past, Uncle G. This is another interesting way of getting into REITs, guys. What this is, and a lot of you guys, I noticed one of my subscribers is actually looking into buying into one of his funds. This is a whole nother spectrum of investing, because with a REIT, when you buy this, the only way you get your money out of it is by selling out of the REIT, and you'll be left with whatever you have left over that you can put into another stock, or you can trade it as you please. You can do whatever you want with this whenever you want, but with Cardone Capital, you can't. So essentially, they have accredited and non-accredited investors, and what you're going to do is piggyback on a huge deal. So this is a $50 million deal to non-accredited investors, which means you make less than 6 figures a year, you don't have $1 million in the bank. And most people can't even get access to these funds, and Grant Cardone is one of the first companies in the US to actually allow people to do this. And his fund under management is worth roughly about $1 billion something, I think. Don't quote me on that. And he's starting to do public funding, which is really interesting. So if you give this guy $5,000, or let's just say $10,000 to make it an even number, but the minimum investment is $5,000, you'll get on average a 6% return paid monthly. So at $10,000, you'd make $600 a month, or not a month, a year, paid out monthly, which is about $50 a month. But you also have to remember, if you're a Canadian investor, you'd be losing about 15% of that. So you'd be really getting about a 5.4, 5.3% yield. Either way, it's a very healthy yield, and you're going to own this one piece of real estate. It's worth about $50 million, or the fund size they're looking for, it will be about $50 million. They're looking for an IRR, basically a rate of return of about 15%. And they want a 10-year hold. So in 10 years, if you give this guy your money today, you're never going to be able to touch that initial investment for 10 years. But in 10 years, if they give you an average rated return of 15% minimum, that means you're going to get you're basically, this 10,000 will become 15,000, or the 5,000 will become let me say, am I saying that right? No, it'll become 5,000 will become 12,500. If you put 10,000 in here, it'll become worth about 25,000. Just to give you an idea of what the minimum they're trying to give you as a rate of return. Part of that will be part of the dividend, and the other part of that will be when they either sell the property or buy you out at property value 10 years from now. But this is a really interesting way to piggyback. So you're not getting as high a dividend yield, but after that 10-year hold term, you'll get a really high payout. You won't be getting any more dividends, but you'll be getting a really high payout, which you can go and find another deal to put that money in. But this is another really interesting way in getting to REIT that I've been looking into to kind of expose myself to an actual hard asset that I would have funds in. And this is part of a limited liability corporation, which you also want to look into the tax structures that go along with that, depending on what state you're in or where you live in the world. So I'm kind of weighing the options of maybe diversifying a REIT portfolio by owning GEO, which is a company I already own, which is a prison stock that pays a high yield in the States. I wouldn't mind maybe giving Grant Cardone 5 or 10,000, and then on top of that, putting another 5 or 10,000 maybe in True North. or even diversifying more, giving Grant Cardone a little less, giving this a little less, and maybe even buying a RioCan and having some higher stable investment properties that are in the $1 billion asset range, and then having a few lower ones but pay out a higher yield, which should give me an average of a 6 to 7% return on my REIT part of my portfolio. But this is what I'm currently looking at adding to the portfolio, guys. You can let me know what you think in the comment section below. I hope you enjoyed this video breakdown. We went over a lot today, guys. Really interesting stuff. I love helping you guys out. You guys have suggested so many awesome things that have helped me out in my own investment career. So let's continue working together in our financial independence, retire early journeys here, guys. So stay cool, stay awesome, and I look forward to chatting to you real soon.